All right, welcome everyone. If you haven't already, go ahead and introduce yourself to the people at your table. If you have not already. All right. Well, we will go ahead and get started. So welcome and thank you all for joining us this month at On the Menu. My name is Alicia Josie and I am the program manager here at the Research Triangle Park. So for today's topic, we're going to be talking about choosing the right business structure. So I imagine a lot of you are either thinking about starting a business, or do you have anyone here who currently owns a business? Maybe you're thinking, okay, is anybody like thinking about changing your business structure, your current business structure? Or just kind of getting some information? Okay, well, our session leader will cover all the pros and cons of each business structure in today's presentation. So I'll go ahead and hand it over to our session leader for today, Timothy Iseler. Timothy founded Iseler Financial to help creative professionals make smart and intentional decisions for a future of personal and financial freedom. Prior to starting the firm, he spent 18 years in the music industry as a recording and touring audio engineer. Tim lives in Durham, North Carolina with his family.
All right. Hi, everybody. Thanks for being here today. Thanks to Alicia for setting this up. I'm super happy to be here. My name is Tim Iseler. I'm a certified financial planner, and I do run my own financial advisory over in Durham NC. And today we're going to talk about some of the factors that can influence which business structure is a good fit for you. Before we dive in, I'd love to just take a minute and tell you about myself and about my business. So as I mentioned, I am a certified financial planner, and Alicia mentioned that my background is actually in the music industry. I spent 18 years working as an audio engineer in both recording studios and touring with bands. And I started my business to help other creative professionals reduce stress while taking control of their financial futures. And a lot of my clients are self-employed, and I've been self-employed in one way or another for most of my adult life. First as a freelance audio engineer, then a one-member LLC, and now I run my business as an S-Corporation. I learned a lot of the things the hard way, and I hope that my presentation today will help you avoid some headaches on your own journey. But I want to be clear up front, I'm not a business coach, I'm not a business advisor. I help people with their personal finances. Some of my work involves helping my self-employed clients understand how to transfer business profits from their businesses to themselves, and tax planning and saving for retirement when you are both the boss and the employee. Sorry, one second. Oh man. I'm sorry about this. This computer is not my friend. Sorry, everyone. All right. Great. Okay, so I trust that you know how to run your business. I'm not going to tell you that, but I hope that the information I share will make some of your decisions a little bit easier. And if you should want to talk about your personal finances in the future, I hope you'll consider giving me a call. All right, so let's get started. It's easy to get confused when you're trying to decide which business structure is right for you. Do you want the no strings attached freedom of being an independent contractor? Is it important for you to separate your personal life from your business life? And what about simplifying your tax planning so that you have fewer surprises when it comes to your annual IRS filing? Any of those questions will influence, or the answers to any of those questions will influence which structure is better or worse for you. There's a lot that we're going to cover today. I'm going to do my best to keep it big picture and focus on concepts instead of details. And my goal is that you'll be able to walk away with at least enough information to sound like you know what you're talking about at a cocktail party, but not so much that you get overwhelmed. I'm going to do my best to keep this to around 35 minutes, and we'll leave a lot of time for your questions at the end. So there are no, your business structure is going to determine your personal liability for the debts and obligations of your business and your co-owners. It's going to determine how the IRS treats your business profits, which fundraising options are available to you, and how your ownership basis impacts recognizing business losses or capital gains for tax purposes. There are no right answers here. Each option is going to involve giving up something that will be really important to someone else. So the right choice for you is going to be the wrong choice for someone else, and vice versa. For example, if your goal is to operate your business for the rest of your life, you're probably not going to care all that much about what happens when you sell. But if you're an entrepreneur and the whole purpose is to scale and sell a business, that's going to be a big motivator for you. Here's a list of the structures we're going to cover today. There are a few others. We're just not going to talk about them. Sole proprietorship, general partnership, limited liability company or LLC, subchapter S corporation or S-Corp, and subchapter C corporation. And don't worry, if you don't know the differences, we'll talk about them as we go along. I do want to say that generally speaking, it's much easier to add complexity than it is to remove it. So if you are uncertain, it's probably a good idea to start simple and wait until there's evidence that you need to move to something more complicated. So I want to just take a minute and distinguish between two types of owner mindset, and depending on where you fall within this, some of the issues will be more or less important to you. The important thing is that we just distinguish that some people want to do the work of the business and some people want to manage the work that's being done. So for a practitioner, the entire purpose of the business is to allow that person to profit from a skill. You could think about a dentist with a solo practice. You know, the entire purpose of that business is so that that person can practice dentistry. A manager mindset, on the other hand, might have a great idea for a new business, but they're looking to delegate some or most of that work to employees. In other words, the operation of the business does not hinge on that person's labor or time commitment. I also want to take a minute right now and just tell you, I'm not a big city lawyer. I'm just a simple small town financial advisor trying to help the nice people with their money. So don't go around telling your friends, Tim says, I can't get sued because I have an LLC. I'm not telling you that. I'm also not some big city tax expert. I know a lot, but I'm not a CPA. So please, I'm not giving you legal advice. I'm not giving you tax advice. If you have a big question, please consult your lawyer or your CPA. So on that note, let's get started with liability. When we talk about liability, what we're talking about is how much are you as the business owner personally responsible for the debts and obligations of your business and your other co-owners. So there's two sides to that. There's a financial component and also a legal component. I think it's probably pretty straightforward why you would not want to be personally responsible, or why you'd want to separate your business debts from your personal debts. For example, if your business goes under, which happens all the time, you probably don't want your house being sold as part of settling your business debts. Similarly, there's almost no situation in which you would want to be personally liable for the actions of co-owners. And this is really not that much about how much do you trust another person as it is how bad will things be if they go wrong. For example, if your co-owner is getting divorced, which also happens all the time, you probably thought that your business had nothing to do with that person's marriage, but depending on how your business is structured, you could find it getting carved up or even completely liquidated as part of that settlement. On the legal side is also pretty easy to understand. If somebody slips and falls outside of your business, are they going to sue you or are they going to sue your business? On the screen here, we have the business types we're going to talk about separated by the level of owner liability. And notice that sole proprietors and partners have unlimited liability when it comes to business debts and obligations, while the other ones offer at least some kind of liability protection. That might seem like a good reason to avoid operating as a sole prop or partnership, but obviously those exist and people use them. Can anyone think of why you might want to accept that level of liability? All right, I'll tell you. It's because they're simple. For some people, unlimited liability is a fair trade-off for the simplicity of running their businesses that way. So when does it make sense to accept unlimited liability? And the answer is in a riskless situation. And you might say, what the heck does that mean? Because every business has risk, and it's true. When we talk about a riskless business, what we mean is that all significant risks can be insured against. I'll give you an example. My CPA works from home. We communicate by phone and by email. And I'm not going to her home office, so I'm not going to slip and fall on her sidewalk. It means that her general business liability insurance requirements are pretty small. And also, CPAs and financial advisors are required to carry something called errors and omissions insurance, which protects against lawsuits for professional errors or omissions of information. So let's say that my CPA screws up and it costs me $10,000. As long as she has more than $10,000 of errors and omissions insurance protection, she will not be on the hook for my lawsuit. So in this situation, she might just want to buy the Gold Star insurance policy and operate as a sole prop because it's very simple. For everybody else, though, it is impossible or financially unreasonable to anticipate or insure for any risk. I just heard an interview with Johnny Knoxville, and he told a story about one of the stunts they wanted to do in a Jackass movie where the insurance policy for just that one stunt cost the same amount as the entire budget for their film. So the point I want to make is, even if you can anticipate the risks, you might not be able to operate your business with that level of insurance. So unless you fit into one of those narrow categories where you can anticipate every professional risk and insure against it, limited liability is your friend. So let's move on to something fun, like income taxes. I'm not going to go out on a limb here. I don't think I'm saying anything too radical. Nobody likes paying taxes. If you can get a tax break, you're probably going to take a tax break. So I'll just assume that limiting your tax burden is probably interesting to everybody here. Pass-through entities are those business structures where all profit and loss passes through from the business to the individual owner. And these business types do not pay income taxes at the business level, although LLCs, partnerships, and S-Corps do have to file annual statements of profit and loss with the IRS. Instead, all of that business profit and loss passes through to the owner and shows up on the individual tax return. C-Corps stand alone as having to pay taxes at the business level. And the simplest pass-through types are sole props and partnerships. And as far as taxes are concerned, there's no difference between the business profit and loss and the personal profit and loss. For that reason, all profits are treated as self-employed income, whether or not you actually treat that as compensation. This next bit trips up a lot of people. An LLC gives you limited liability protection, but an LLC is a business type and it is not a tax structure. The default treatment, the IRS default treatment of a one-member LLC is the same as a sole proprietor, and a multi-member LLC is treated as a partnership. In fact, the IRS goes so far as to call a one-member LLC a disregarded entity. And that means that as far as income taxes are concerned, there is no advantage to having an LLC. It doesn't mean you shouldn't do it. It doesn't mean it's not good. It just means you're not going to save on your income taxes by having an LLC. So why does that matter? Well, pass-through businesses have all profit treated as self-employed income, and self-employed income has a special tax called, cleverly enough, self-employment tax. This is not quite the same as FICA, but it pays for the exact same things, which is Social Security and Medicare benefits. And just to be super clear, both FICA and self-employment tax are in addition to whatever you pay for your normal income tax. Now, it is true that those expenses are split between employer and employee, and the employer half counts as a deductible expense. But we should all note that that deduction does not put the money in your pocket. Both halves, since if you're the business owner, both halves are getting paid out of your would-be profits. And so even though you do get a deduction for half, you still have to pay that money. So I mentioned a minute ago that an LLC is a business type and not a tax status. The S-Corporation, on the other hand, is exactly a tax status. I've included a definition here from the IRS, but what you need to know is an S-Corp is a qualified business that has elected to be treated as a pass-through business. And I want to make one note, the IRS uses the word corporation in their definition, but an LLC can also elect to be treated as an S-Corp. So I just mentioned that the IRS treats all profits from sole props, partnerships, and LLCs as self-employed income, and it's subject to self-employment tax. With an S-Corp election, though, shareholders can be treated as employees. And in fact, in most situations, if a shareholder has any active involvement in the business, they're required to be treated as a W-2 employee. And that means that that salary reduces the profits and everything that's left over passes through as ordinary income. So ordinary income is still subject to income tax. It's just not subject to employment taxes. In other words, when you have your one-member LLC, all of the profit is subject to that self-employment tax. But when you have an S-Corporation, only your salary is subject to FICA. And by the way, the IRS stipulates that S-Corp owners have to be paid a reasonable, in quotations, salary, but they don't stipulate how you calculate that reasonable salary. There is some flex in there. I'm not going to tell you what you should do because I'm no big city CPA, but you might want to talk to your CPA about what would be considered reasonable. So part of the profits with an S-Corp can pass through and avoid that employment tax, which will save you money overall. That does put money into your pocket. One quick note, can anyone think of why you would not want to avoid employment taxes? Yeah.
I would say something like the pandemic, you have to lay yourself off, you're not paying into the UI benefit, unemployment benefit.
Well, UI is different. UI is a different thing than FICA or self-employment, but you're on the right track, which is that those things pay for Social Security and Medicare. And if you think that at some point in your future, you're going to need to rely on Social Security to pay for your retirement, you might want to just suck it up and pay those taxes now, rather than saving the money now and being out on the street when you retire. So now we get to C-Corps. C-Corps are subject to what is called double taxation. And what that means is all profits are taxed at a flat 21% corporate rate. And any profits that are distributed to shareholders in the form of dividends are also subject to dividend tax rules. In other words, the exact same profit gets taxed twice whenever it is distributed to the business owners. However, C-Corps can retain earnings. Remember the other business types, all of the earnings flow through. So C-Corps can retain earnings, which lets them control when or if to distribute any of those profits. And I have a note here at the bottom, the IRS distinguishes between ordinary dividends and qualified dividends. And there are a number of rules that go with that, but all you need to understand is if you've owned your shares for more than a year and a day, they're probably going to be treated as qualified dividends. and qualified dividends are taxed at a more favorable rate. The maximum qualified dividend rate is 20%, even for people in the very highest tax brackets. So on the right side of the screen, we can see that after you pay yourself, everything that's left over is subject to corporate tax of 21%. And then if you distribute that money to yourself, it is subject to dividend tax rules. So when would it make sense to subject yourself to double taxation? The answer is whenever your business profits are going to put you into the very highest tax brackets. So if you're looking at $5 million in gross profits, you would probably be pretty happy to not pay 37% on the bulk of that, which is the very highest tax rate. And you're just going to have to trust me. I've done the math. Even after the flat corporate rate, if you can transfer that money to yourself as a qualified dividend and pay 20% on it, you're still going to save money. So this is my big takeaway for C-Corps. They don't make any sense until there is a lot of revenue. Next, we're going to look at fundraising options. So no matter how big or small your business is, there will be some time when access to more money than you can generate through your business operations would be helpful. And depending on your business structure, different options will be more or less attractive or even unavailable to you. So there's two ways that businesses can raise funds. We have debt and we have equity. Debt means most commonly taking out loans or in some situations issuing bonds, and equity means selling a stake in your business. There's nothing wrong with either option, but it's important to understand the trade-offs. So when you take on debt, you access money now with the agreement that you pay it back later, plus some premium, which is interest. We normally think that debt is a bad thing in our personal financial lives, but it can be a great thing in your business. So let's say, for example, that you know that you can increase revenue by 100% if only you could get some more money. And let's say that the only business loan you can get charges a 25% annual percentage rate, which is huge. And you might say, heck no, I'm not taking that 25% business loan. That's insane. But if you can grow your revenue by 100%, that still leaves you at a 75% growth rate, which is still huge. So it might be totally worth it for you to do that. And the final point I want to make here is that whether you want to take on debt or not, it's often the only path that's available to raise funds. Loans are the most common way to access debt, and your business structure determines how you are going to be impacted by your business loans. So since sole props and partnerships have unlimited liability, the owners of either of those types are going to be on the hook for business debts. And that means that often sole props and partners are going to have to rely on personal loans or personally guaranteed loans. LLCs and S-Corps do have a separation of business debt and personal debt, but the lender is going to want to see evidence of profitability and growth before they loan you that money. So even though it's not technically required, partners and LLC members and S-Corp shareholders may still need to personally guarantee business loans. And because C-Corps are completely separate from their shareholders, and because they generally don't make any sense until there's already a tremendous amount of revenue, it is extremely unlikely that a C-Corp shareholder would need to personally guarantee a loan to the business. So most of you will never issue bonds. Bonds reverse the normal borrower-lender relationship. So when we think about a loan, an individual goes to an institution or even just somebody who has more money and borrows. So the individual borrows, the institution lends. With bonds, it's the opposite. The individual is the lender and the institution is the borrower. So when you buy a bond, you're loaning your money to a business or to a government in exchange for an interest payment. Technically, small businesses are not prohibited from issuing bonds. And as crazy as it sounds, it is possible for a one-person business to issue bonds. But bond issuance requires adherence to a lot of state and federal regulations, which is very complicated and costly. And for that reason, it almost only ever happens with very large corporations. And for our purposes today, unless you anticipate running a very large C corporation, you're probably never, ever going to be in the position to even look into issuing bonds. So when you sell equity in your business, you get a one-time influx of cash in exchange for giving up some ownership. One advantage that selling equity has over debt is that owners don't have to be paid back. If my business fails, nobody gives me my money back, right? So what this means is that even though selling equity reduces your power within your own company, it allows you to take on bigger risks than your growth plan than you would if you could only access debt, because you don't have to pay those people back. So selling equity means giving up a stake in ownership, and that those new owners probably have their own ideas about the right way to run a business. And that could sound terrible for somebody with a practitioner mindset. But I want to give you one example of why even a committed practitioner might want to bring on another owner. So let's say, for example, I own a Nissan dealership and I'm a practitioner and I love selling cars, and I would do it day and night, 7 days a week if I could. But what's the reputation of car salespeople? They're often thought of as untrustworthy. What if I could bring on a new business owner who came with a lot of trustworthiness? Let me tell you what I know about Michael Jordan Nissan in Durham, North Carolina. Number one, they sell Nissan automobiles. And number two, Michael Jordan is the greatest basketball player of his generation. It doesn't matter that Michael Jordan doesn't sell cars. Having that name on the top of the building and on the back of every car gives it sort of instant credibility that you might be very happy to give up an ownership stake to have. All right, when you're selling equity, first thing to note is you cannot add a second owner to a one-owner business. So sole props cannot sell equity. Partners and LLCs can bring on new partners and new members, and there's no limit to the number of members an LLC can have. I put an asterisk next to partnership there. I've searched high and low. Some sources say a partnership can have 20 partners. Some sources say 50, and some say 100. And the IRS lists partnerships with more than 100 partners on their webpage describing large taxpayers. So I can't tell you with any degree of confidence how many partners you can actually have. But I can say with a very high degree of confidence, if you want to start a partnership or an LLC with more than 19 of your closest friends, you should call a big city business lawyer, because it's going to be complicated and maybe very, very messy. S-Corps are limited in the number of shareholders they can have. They're limited to 100 shareholders, and those shareholders have to be people or estates or trusts. And they're also limited to only one class of stock, although you can issue both voting and non-voting shares. I also want to point out that certain accounts like 401ks and like employee stock ownership programs can count as separate shareholders if they hold company stock. And that means that any S-Corp with more than just a handful of employees is going to have a really hard time doing any kind of equity compensation program. C-Corps, on the other hand, can have an unlimited number of shareholders, and they can issue different classes of stock. And shareholders can be other businesses. That means that C-Corps can have a path to being listed on public markets, which is the only reason anyone ever does that is because it generates a lot of money. Because C-Corps can issue different classes of shares with different voting rights, a founder can sell millions or even billions of shares and still retain ownership. So Mark Zuckerberg owns or controls 90% of the Class B shares in Meta, which have 10 times the voting power of the Class A shares. That means he can never get outvoted in his own company. And finally, because C-Corps can have unlimited shareholders, that means that the equity compensation issue goes away. And so they can effectively implement a stock compensation program. So a rule of thumb, debt's a good option if you know that your plan is going to work and you just need the money. Because if you know your plan is going to work, why would you give up power in your company? You just pay off the debt. But if you simply hope that your plan will work and you want to test it out, you might want to consider selling some equity and let someone else pony up the money that you don't have to pay back. All right, our last topic for today is ownership basis. Now, most people don't walk around talking about the basis in their house or the basis in their business or the basis in much of anything at all. It's a technical term and it only relates to taxes. I included a blurb from the IRS on the screen, but basically what you need to know is your basis represents what you paid to acquire an asset, plus taxes and fees related to acquisition, minus any financial benefit or tax credit that you get along the way. So when you put more of your money into your business, your basis goes up. And when you take money out of your business, your basis goes down. And why does this matter? Well, your basis determines the tax consequence of selling your business. And it also determines how much, if any, of operating losses you can claim on your personal income tax returns. So when you sell, your basis determines how much of the sale price is a return of your own money, which is tax-free, and how much is a capital gain or loss. So let's say I write a personal check for $100,000 to start my business because I've got that kind of money. I'm not worried about it. Let's say that a year and a day from now, I sell my business for $101,000. That first $100,000 is just my money coming back to me, and it's not taxable. The next 1,000 is a capital gain, and it's subject to capital gains rules. But let's say in that year, I transferred $100,000 back to myself. Well, now my basis is zero, and I'm stuck paying capital gains on the entire $101,000. There's a big difference between paying taxes on $1,000 and $101,000. So the capital gains rules are the same for all businesses. I want to point that out. And I want to note, or excuse me, let's note how, or let's look at how business losses impact business owners. So please note this only applies to pass-through businesses. So C-Corps don't get this. Remember that with a pass-through entity, all business and loss passes through to the owner. And the owner of a pass-through business can recognize business operating losses on their tax return up to their basis. So let's say your basis in your business is $10,000. This year, your business loses $10,000. You can use that $10,000 loss to offset your other income. But because you realized a tax benefit, that drops your basis back down to zero. So the most obvious way to increase the basis in your business is to just transfer money from yourself to your business. Again, this doesn't apply to C-Corps. And small business owners can also increase their basis by not distributing their profits. Remember that all the profits are yours and you're getting taxed on them. So if you choose to leave them with a business account, that means you've basically given your money to the business. Small business owners can also increase their basis by increasing what's called your risk basis or your at-risk basis, which means your investment plus whatever portion of business debts that you are personally liable for. So remember that with sole props and partnerships, there is unlimited liability. Business debts are personal debts and vice versa. And the default treatment, the IRS treatment of LLCs is either as a sole prop or a partnership, depending on how many members there are. That means that owners of sole props, partnerships, and LLCs increase their basis whenever they are personally liable for business debts. S-Corps are different. Business debts do not increase your basis when you're an S-Corp shareholder, even if you have personally guaranteed those loans. This is a big disadvantage that S-Corps have compared to LLCs. And we'll finish up today with a look at C-Corps and basis. Remember, C-Corps are not pass-through entities, so there's no way for shareholders to recognize operating losses. Also, any distributed profits are treated as dividends and not a return of your capital, so that doesn't impact your basis. And unlike with the other business structures, even a loan from a shareholder to the corporation is just considered a loan. It's not an equity contribution, and it doesn't impact your basis. So the only way that C-Corp shareholders increase basis is by acquiring more shares, either by just buying them or through some sort of compensation. And likewise, the only way that you can lower your basis is by selling your shares. And the tax consequence of selling shares depends on your basis. If you sell above basis, you have a capital gain. If you sell below basis, you have a capital loss. The rules for capital gains are analogous to the rules for dividends, which is that if you've owned your shares for more than a year and a day, you get a preferential tax treatment, and it maxes out at 20%. So the only way that a C-Corp shareholder can recognize a loss is by selling below basis. And then the rules are that only the first $3,000 can offset ordinary income. The rest of it can only offset capital gains, and whatever's left over has to be carried forward. And by the way, those rules about selling below basis apply for other businesses too. It's just that those business owners have different ways to recognize losses. So we'll quickly just wrap up. The structures we talked about today are sole proprietorship, general partnership, LLC, S-Corp, and C-Corp. The issues we talked about are your personal liability for business and co-owner debts and obligations, how your business profits get taxed, how your business can access money to fund growth, and the tax implications of your ownership basis. And finally, just some big picture stuff. Sole props, partnerships, LLCs, and S-Corps are generally suitable for practitioners, while LLCs, S-Corps, and C-Corps are generally suitable for people with more of a manager mindset. S-Corps and sole props are restricted in the number of owners they can have, and maybe partners, but talk to your attorney. And it's always easier to add complexity than it is to remove it. So that's the end of my presentation today. I'd like to thank you for taking time out of your day. I super appreciate it. As a thank you, I'm offering a free download. What issues should I consider as a business owner or 1099 worker? You can go to iselerfinancial.com/RTP, or you can scan that QR code. I'd love to answer any questions that you have with the remaining time, but if we don't get to something, or you think of a question right after you've left, you can shoot me an email. That's on the screen there, or you can schedule a free 15-minute Q&A using that same link, iselerfinancial.com/RTP, and that same QR code. So I'd love to field any questions that you have. Yes.
My name is Dinesh Kaushik. I want to check up. You see, you have given that profit and loss, or suppose the losses are there, which is below your basis, can be carried forward. Is there any limitation of the number of years that the losses can be carried forward, or it is perennial for whatever time you are in the business?
Operating losses should be able to be carried forward. Are you saying as long as you're in business, or just a general limitation?
Limited to certain years, can offset your losses
Right.
against the future profits.
Against future profits, yeah.
And then there is a limitation of the period. I want to check up whether there is a limitation of the period, or it can remain as loss until I recover. So for example, I am making losses for 15 years.
Yeah.
Or 5 years or 2 years.
Yeah.
To what extent I can offset my losses incurred in the current year, and what are the limits of the?
Yeah. My understanding is that that can be carried forward indefinitely.
And is it to be offsetted against the year of occurrence on first in, first out basis, or it makes a pool and then it goes up?
Oh, that's an interesting question. I mean, I'm not sure On a first in, first out, well, I guess I'm not sure how that would matter.
I also got little inquisitive about it, so I thought.
Yeah, thank you. To be honest, I don't know that you have to recognize the first year's losses versus the fifth year's losses. Because if you're carrying it forward, I believe it just sort of snowballs and becomes one big pile of loss that you're carrying forward. I could be wrong about that though. Yes. Oh, wonderful. Thank you. Any considerations for joint partnerships between two entities? I can't think of considerations other than would also apply for individuals. I guess you might consider what each entity, what kind of liability protection they have on their own. So for example, if two corporations formed a partnership, they would have a high degree of liability protection on their own, but I think the concerns are mostly the same. Any considerations for spin-outs of a parent company? I guess the considerations would be the ones we talked about, like how do you want those to be taxed? How do you want the owners to be treated? Yeah, gosh, I'm sorry. I wish I had a better answer for that.
Yeah, any advice on how to partner with Michael Jordan?
How to partner with Michael Jordan? I don't know. I mean, maybe Michael Jordan has a cousin who sells Nissans. I'm not sure.
Intrigued by one of your last slides. Practitioner versus entrepreneur. I'm guessing that applies to more folks than myself. Like I'm starting into paid voice acting work, which relates to an audio engineer. And a few of my voiceover professionals have that question on, is it a safe enough place if you're doing mostly auditions and you're not necessarily doing coaching these products that you don't necessarily need to think about all the things that it might involve? What's associated with an entrepreneur LLC, or in your opinion, working in the industry, when is the right time to make the jump? You calling yourself an entrepreneur or person?
Well, I think the question was sort of related to when are you a practitioner, when are you an entrepreneur? I know people who run one-person businesses who consider themselves entrepreneurs. What I'm sort of, my distinction was whether you are the person doing the work or whether you are the person hiring people to do the work. So if you're a voice actor, you absolutely can consider yourself an entrepreneur. There's nothing wrong with that. But the business still hinges on your ability to do that work. So I could see if you were looking to put together like an agency where you were managing several other people and your voice work was one of the sources of revenue, but you're also managing several other people. That fits a little bit more with how I'm distinguishing that, but lots of one-person businesses one-person owners consider themselves entrepreneurs. Does that help?
Yeah, I think the other part is how much revenue is usually a good point. Like with all the expenses and operations that are involved, to say, now it's time to get serious, because I'm sure a lawyer would say, oh, just do it right away. But not everybody has that luxury of just doing a lot of spend before money comes in. Yeah,
so that's less about like what your mindset is and more about what your structure is. There was a question about at how much revenue does it make sense to switch how you're operating. So there's different ways to think about it. There's just like crunching the numbers. That's one way to think about it. And the distinction there would be like switching from an LLC to an S corporation would make sense. Even if you have a one-member LLC to an S corporation. Certainly there's a point where it's just down to profit and when you save more on taxes. I'll give you another example though, and this is why I run my business as an S-Corp. I worked for many, many years as a freelance audio engineer. And then I started a one-member LLC, which was when I was still an audio engineer, not this business. And then I was surprised when I filed my taxes and saw that I didn't save any money at all. So when I started this current business, one of my objectives was to be able to pay my taxes with every single paycheck I gave myself. And it was less about, is this, am I optimized for tax efficiency, and more about, I don't want to get surprised in April when I find out I owe the government $10,000 and I thought I was totally cool. So there's different factors. If you want to crunch the numbers, we can come up with a number, but I mean, probably if you're making less than $50,000, there's not going to be any consequence. And if you're making more than $100,000, there probably could be some savings to switching to an S-Corp. And I would also say this too, it depends on how much of that money do you need to live, right? So if the only money that's coming in, you need to actually pay your bills, you might not actually want to put the work into distinguishing what part is your salary and what part is just your owner draw. So I hope that helps. Yeah.
First, thank you for the information. Great.
Yeah, you're welcome.
Just so I'm clear, from a risk liability standpoint, there's no real benefit if you have E&O to an LLC versus partnership or sole proprietorship. There's no real benefit, right? Because the E&O is already covering what you would normally have the LLC for from a liability standpoint. Is that accurate?
Yeah, so the question is for industry specific insurance like E&O insurance, is that basically the same no matter what your business structure? And the answer is yes. You need that insurance. I guess you don't need to, but you would be open to a huge amount of risk if you didn't have it. And it's the same insurance whether you're a sole prop or an LLC or an S corporation. It's the same insurance. You might want to change, say if you were operating as a sole prop versus an LLC, you might want to really up your coverage. But in general, I think if you're buying some of that industry specific insurance, it doesn't hurt. It doesn't cost you very much more to increase your limits anyway. So, and again, like, even if I were running my business as a C corporation, I would still need E&O insurance. It's less dependent on the business structure. Yeah, you're welcome. Hi.
So when I started I started a real estate company. When I started the LLC, talked to a tax guy, and he went in and said, all right, well, we'll use the LLC, but he went in and put something that made it file as a S-Corp.
Yep.
Is that the same as changing it to an S-Corp, or is that?
Great question. Yeah, so it was about it's called an election to file as an S-Corp when your business is an LLC. That is what I do. My business is registered with the state of North Carolina as an LLC, and I filled out the form so that I could be treated as an S-Corp for federal tax purposes. And it would be the same if you had a C corporation and your shareholders elected to be treated as an S corporation. That is what it is. It's like your business elects to be treated as an S corp. And there, the rules around that is that it has to be a small business. You can't have, you can't have a giant company with lots and lots of shareholders and then turn it into an S corp. But that is the same thing. And the forms are different. If you want to go LLC to S corp versus C corp to S corp, they're different forms, but that's what they do. Yeah.
Talk a little bit about the difference between state and federal. We're all registering our business in the state,
Right.
Federal government. So what's the breakdown there? Maybe costs and filing annual reports, things like that. Does a sole proprietor have to file an annual report?
Yeah, great. So the question is about tax filing requirements with the different business structures. Sole props do not file profit and loss statements. In that case, you would do a Schedule C, but that's with your personal taxes. I'm sorry, what was the first thing you said?
Just about the difference between this, what's happening.
Oh, right, at the state, at the federal. So the federal government kind of like, puts up the tent, and usually the states are kind of like somewhere within that tent. Sometimes they have radically different rules, like there are states with no state income tax, right? And, they sort of stand apart, but usually the state treatment mirrors kind of how the Fed treats it. So, like the statement that I file with the federal government, with the IRS, that says my annual profit and loss, that directly feeds into the statement that's given to North Carolina, right? It's like North Carolina looks at, it's the same with your personal tax returns. North Carolina is going to look at the bottom line of your 1040 and use that sort of as the starting point on your North Carolina taxes. It's very similar for businesses. All businesses have to register at the state level. There is no business that registers at the national level. So even Apple Computer is registered in California, right? Even though it's an international company. And when you make the IRS doesn't actually recognize LLCs as much of anything. So the S-Corp, the whole purpose of the S-Corp election is so that the IRS recognizes your business as being different. If you're running your business as a C-Corp, there's already tons of rules about that. And so, the state and the federal are kind of fall in line. But gosh, I hope that answered your question. I'm not sure.
Yeah, I think it does, kind of nebulous, the whole.
It is a little bit,
how it all works.
yeah. And if you had the option, some people do have the option to register their business in another state. Like a lot of businesses register in Delaware because Delaware has favorable rules for corporations. If you were in that position, you could probably dig into that a little bit further, but most people, where they live is where they file. And so really the choice then is more about how the IRS is going to treat your profit.
Okay.
Hope that helps.
Yeah. Totally over there.
Hi,
First of all, that's an excellent presentation.
thank you very much.
No lawyer, no accountant, no CPA that ever explained it to me like you just did. So thank you.
Wonderful, thank you.
So, but I do delegate to my CPA, so I should ask this question. I'm just curious. On self-employment tax?
Yep.
What was the percentage you say?
The percent that you pay in self-employment? It works out to be something, I think it's like 14.13. And it's a little bit complicated because the entire thing, I said the entire thing is subject to self-employment. It's the vast majority of it is, but there's a small portion that isn't, and the calculation's a little complicated, but it works out to 14.13 versus FICA, which is 15.3.
Deduct the percentage of the self-employment tax?
Yep. That is a deduction on the first page of your 1040. You get to deduct the employer half of that, but not the employee half.
Just one other quick question. Years ago, somebody gave me a personal loan, and
Mhm.
I paid it off, but it was to the business. How do you set up a personal loan? Or is it done legally, or is it just?
Oh, a question about personal loans. Well, if somebody just writes you a check, it's sort of like an honor code. If somebody writes you a check and you pay them back and they don't charge you interest, it is a loan. And because they didn't charge you interest, there should be a tax consequence. However, if neither of you ever say anything to anyone, it kind of doesn't exist. If you want to do it the right way, what would happen is the individual would, and you're talking about from one individual to another, is that what you mean? Right. So the individual would go to the lender would go to their bank and say, I want to set up a loan to my friend, and we're going to pick a rate of interest where there's no kind of gift tax consequence. And then they would set it up that way and you would pay them back through their bank. If somebody gives you a loan and they don't charge you interest, that is considered a taxable gift. But again, if I'm not telling you what to do, but if nobody reports that, it kind of doesn't exist. Yeah, you're welcome.
I think that equity question is really good about, well, Michael Jordan, I think he could use, Casey Kasem was.
Yeah.
Do him. So, how do you compensate that person? What does that look like? Like, what's Michael Jordan getting out of it?
Oh, yeah.
Right, a stockholder, a dividend, they pay themselves, let's say $1,000 a month.
Yeah.
And now they're only able to pay themselves 800 and Michael Jordan gets 200.
Right.
So how does that?
Yeah. So how do you compensate, somebody who's buying an equity in your business? I don't know. I'm guessing Michael Jordan's getting a pretty good deal on that. I don't know the cut that he's getting, but I would think that he probably would not be willing to put his name on a business unless he was getting very favorable terms. If it were you or I, it would probably be a lot different. Like if all you were walking in with was your money, you'd probably get, some small percentage of profits would be paid out to you regularly. If you're walking in, like if you're the most famous car salesperson in the Southeast and you buy into someone's business, that's worth a lot more. You might get, I don't know, maybe Michael Jordan gets 50% of the profits from that business. I don't know, but the name on that building is the business. Otherwise, it's just, Joe's Nissan dealership, and who knows about Joe.
So how does it work with the equity? Let's say it's 20% equity.
Yeah.
There might be other.
Oh, yeah,
things
yeah.
about compensation,
Yeah.
but just that equity share. So if there's 100 shares of stock and I'm doing 20% to Michael Jordan.
Yeah.
Is that a direct impact? Like he's now got 20%. Does that impact the dividend I could pay myself as the manager?
Great question. So if somebody's a 20% shareholder in your corporation, that is what that would mean. It would mean that they are entitled then to 20% of the profits. If they ran their business as, if you have a partnership or an LLC, you can sort of divide how much of the ownership. So if somebody was a 20% member of an LLC, it would be similar. They would be entitled to 20% of the profits. You may also, in the case of an S-Corp, you may also add on to that, you'll also get a salary of $100,000, so there's other ways, because the salary counts as an expense and not a distribution of profits. So that might be one way to do it. But it's really like, if it's something as direct as that, as I'm buying 20% of your business, that is what it means. It means you're entitled to 20% of the profits.
Okay, so can you explain real quick, like disbursement from dividends?
Yeah.
Are the same versus like a bonus?
Uh-huh.
Like what's the
Yep.
kind of difference there?
Yep. Yeah. So if you're dealing with an LLC or partnership, you're stuck with the profit is self-employment income. If you're dealing with a corporation, you have your salary, which is taxed like your salary from anyone else, and a bonus would be taxed similarly because it's compensation, right? A bonus is not just like money because they like you, it's some kind of compensation, and it gets taxed that way, and it reduces the flow through profits. With S-Corps, the money that gets distributed to you counts against your basis. So when you take that money out, you're reducing your basis. When you have a C-Corp, a dividend is just a dividend. Your basis is the same. So it's entirely possible that through owning a business like that, through owning an S-Corp, that just by taking your share of the profits, your basis in the business can go down to zero. And you still own the same share of it. It's just that should you then sell it, all of it is treated as a capital gain. Does that help? Okay. Yeah.
I will supplement this with your what you have given an explanation which is really befitting, but there is another perspective to this kind of an investment and co-branding, which is when the shares are issued, whether 20% or 30% or 50%, they are issued sometime as a sweat equity. So they don't pay for it.
Right. Yep.
And they are issued shares. So they own the ownership to the extent of the shares issued, whereas they have not invested anything. So there is one benefit. Second benefit, when the branding is there and the brand improves, the sales improve, and the valuation of the company goes up. And when he sells his 20%, which he is entitled to sell to him, to the existing owner or to any other third party, he gets a capital gain, hefty amount, because the valuation is enhanced valuation after 3, 4, 5 years, which is subject to capital gains. And he gets his money, he gets an exit, and he another person will take it into his shoes, and he realizes a large money with a left, for which he has not spent even zero money. Other than whatever he has, Tim has suggested that he might be given annual compensation by way of salary or profit or dividends or whatever. These two are driving factor for these people because they are anyway high on the highest bracket of the tax. So they are looking for long-term capital gain, and where they just lend their name and they don't pay anything for it. So that explains their involvement and joining hands with them.
Yep, thank you. That's the good point. You can receive your equity as compensation. You don't actually have to buy in. I'll take one more question, then we'll wrap up for today.
So, if I have a rental house, does it make sense to have a single person LLC? Does it buy any protection? Having an LLC versus just I own it?
Yeah, absolutely. So if you own a rental property, is there an advantage to having an LLC versus just owning it as an individual? And the answer is yes, it's the limited liability. And so what that means is that yep, absolutely. Yep, that's called a one-member LLC. And you don't receive a tax benefit for having a one-member LLC, but that means that the most that you are at risk for, should something go wrong, somebody sues you, the most you're at risk for is your investment plus your share of whatever the debts are. Right, and also a lot of times, this is just one quick note on property, real estate income. A lot of times it makes sense to make a separate LLC for every single piece of rental property you own. And you could see how, let's say you owned 5 rental properties and they were all under the same LLC. If you get sued for one of them, all of them now can be taken as part of that settlement. Whereas if you have 5 different LLCs, it's possible for one to be completely wiped out and the others still remain. Cool. All right, I'd love to wrap it up today. Thanks, everybody. Thank you so much. Super appreciate it.